At some point in their life, most people have encountered this situation. You're at a cocktail party when the blowhard strolls by bragging about his most recent stock market move. The best and most innovative online retailer of home appliances, WidgetsPlus.com, had a big growth in his investment this time. You find out that he invested 25% of his assets in the business, despite knowing nothing about it and being completely enamored with it, with the intention of quickly tripling his money. He has made at least 4 common investing mistakes, so you start to feel a little proud of yourself. The blowhard at home committed the next 4 mistakes in addition to 4 more for amusement. In this video, we will discuss 10 common investment mistakes made by the beginner investors. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 10. Not investing. The most common mistake beginning investors make is delaying making an investment. Unfortunately, because retirement is so expensive, the majority of us won't be able to save enough for it without a lot of help from the stock market. Imagine saving $250 every month beginning at age 25 and continuing until you are 65 and prepared to retire. When you retire, you would only have $120,000 if you had kept that money in a savings account with no interest. Unfortunately, you probably won't have it for long. But consider what would have happened if you invested that money in the stock market and saw it increase, giving you the opportunity to earn interest on your interest. According to estimates from the Securities and Exchange Commission, SEC, historically, the stock market has generated a 10% annual return. If you donated $250 each month, you might retire with more than $1.4 million. By investing in the stock market as opposed to a non-interest-bearing account, you might significantly increase the same amount of money you have put in over the course of your life. Number 9. Buying shares in a business you don't understand. Another mistake is when investors enter the most current, hot area even though they lack prior company or industry knowledge. You run the risk of losing your hard-earned money if you don't perform adequate research, particularly if you are unaware of the company's financial position. However, when you investigate and comprehend a business and its industry, you have a built-in advantage over most other investors. Number 8. Using money you cannot afford to risk. When you utilize money that you cannot afford to risk, your emotions and stress levels rise, which could lead you to make bad financial decisions. When examining equities, keep in mind your risk tolerance, which is the readiness to lose some or all of your initial investment in exchange for larger returns. When determining your level of risk tolerance, take into account the assets or asset classes with which you feel the most comfortable, such as growth stocks as opposed to bonds. Don't invest finances like rent money or emergency savings that you can't afford to lose. You will make far better financial choices if you only invest money that you can afford to lose. Number 7. Being driven by impatience. The same goes for investors who lack patience. If you're investing for the long term, stocks might not produce the results you were hoping for right away. After a new strategy is unveiled, it could take a company's management team months or even years to put it into practice. Stock shares are bought by investors far too frequently in the expectation of making a quick profit. For instance, the broader S&P 500 index had an average annual return of 9.01% between 2000 and 2021. The 5-year losing streak of the index, which included the 36.5% loss it saw in 2008 during the Great Recession, is shown below. Number 6. Learning about stocks from the wrong places. Getting stock advice or information from the wrong sources is another common and costly financial mistake. Numerous so-called experts are available to share their opinions and position themselves as educated and reliable. Even stock analysts for investment firms, who possess extensive understanding of the company and the industry they cover, can commit errors. In other words, it is still possible for someone to be mistaken even if they are qualified to voice a viewpoint. Websites run by the government and nonprofit groups are generally a good place to start if you're looking for basic financial advice or guidance. An additional person who could assist you with the process is a financial advisor. Number 5. Following the crowd. Copying other investors' strategies is another financial error because it typically requires little to no research and merely imitates what other investors are doing. The bulk of people wait until they have already experienced success before learning about investments. The mainstream media typically highlights price hikes of 2 to 3 times in a particular stock as hot takes. Sadly, by the time the media gets involved, the stock has usually reached its top. At that time, the investment is probably expensive. However, stock valuations may overinflate as a result of media coverage from radio, newspapers, television, and the internet. Number 4. Averaging down. Averaging down can be a costly mistake in investing. Investors will typically average down when they need to make up for a prior mistake. If the stock was purchased for $3.50 and later drops to $1.75, they can choose to purchase more shares at the lower price to make up for their blunder. Due to their recent acquisitions of the stock at $3.50 and more shares for $1.75, their average price per share is substantially lower, making their real loss appear to be much smaller. Since you were putting more money to a losing deal by purchasing extra units of stock that have declined in value, averaging down can also be seen as throwing good money after bad. Averaging up, on the other side, is the technique of boosting share purchases after a stock price increase that shows you made a smart choice. Number 3. Doing too little due diligence. It could cost you money to invest carelessly and make a mistake. Investment funds and venture capitalists frequently do due diligence to ensure the profitability of their investments. The Global Impact Investing Network asserts that organizations with effective due diligence procedures are more likely to foresee possible issues and make well-considered investment selections. Individual investors need to exercise careful due diligence, particularly when buying stock in highly speculative and volatile penny companies. Generally speaking, the more diligent you are, the better your investing results will be. If you've thoroughly researched the company, taking into account any red flags and potential hazards, you're far less likely to be unpleasant shocked by an occurrence. Number 2. Attempting to time the market. When you attempt to time the market, returns are also affected. Timing the market correctly can be difficult. Even institutional investors frequently encounter obstacles on their path to success. In their well-known study, Determinants of Portfolio Performance, Gary P. Brinson, L. Randolph Hood, and Gilbert L. B. Bauer focused on the returns on American pension funds, Financial Analyst's Journal, 1986. This analysis shows that, on average, the investment policy decision accounts for 94% of the change in returns over time. Simply expressed, this implies that decisions you make regarding asset allocation may account for the majority of a portfolio's return rather than time or even security selection. Number 1. Buying and selling based on emotion. One of the most frequent investment mistakes is acting emotionally when making purchases and sales. Because of the excitement surrounding a new investment, you could be eager to purchase because of the buzz. You might purchase assets as a result without doing sufficient research or due diligence. Long-term, you can suffer a loss. Emotionally motivated sales are the exact opposite of the issue. When people panic during downturn markets and sell out of worry for what is happening, losses are locked in. Selling an investment requires careful thought, just like buying one. Before you buy or sell, make decisions based on strategy and logic rather than emotion. By creating a strategy, you can prevent yourself from making these mistakes. Establish your objectives, where you are in the investing life cycle, and how much money you need to invest to achieve them. If you don't think you can handle this, look for a qualified financial planner. Consider your investment objectives in addition. By doing this, you might discover that it's simpler to decide on the best allocation for your portfolio and feel more inspired to put money aside. Adapt your ambitions in light of the market's historical performance. Do not expect your portfolio to make you rich overnight. When a trustworthy, long-term investing strategy is used over time, wealth will be created. This is it for today's video. What do you think of our video? Tell us in the comment section below. Don't forget to like and subscribe to our channel. Thanks for watching.